Hey guys, happy Monday, August 11th. If you follow AMC and you've been waiting for the earnings call this afternoon after the market close, you were probably surprised in the morning to see, like I was surprised, to see that the company dropped their Q2 results in pre-market. Now we do have a live stream scheduled for after hours today, when the company will be having their conference call going over those results. So I hope to see you on that live stream. I love to hear your guys' comments and questions. But, the good thing about the results being dropped in the morning is I've already had time to go through them, compare them to my model, compare them to the July 3rd video I gave you guys with my expectations of Q2. You're going to be surprised at how close my guess was to the actual results. So let's go through these results at a very high level in today's video. Looking at AMC's chart, it got quite a run up in pre-market based on the earnings drop, but that price run up has been mostly erased during the trading day today. We're currently at $3 flat. It was as high as $3.46 in the pre-market hours. What a run up, but they've chopped it back down, and we'll see what happens after the earnings call this afternoon. Q2 2025 box office coming in at $2.67 billion was right on that pivot point where it was very difficult for any of us to tell you whether AMC was going to have a positive or negative quarter. I always err on the side of caution versus the side of hopium, and that cautionary stance was in retrospect, the correct stance to take for this Q2. Let's go over the results from AMC. Total revenues came in at $1.397 billion. Net loss was negative $4.7 million. Adjusted EBITDA was a positive $189 million. Net cash provided by operating activities, positive $138 million. And the free cash flow, a positive $88.9 million. How did that revenue and that loss stack up to the video I gave you guys on July 3rd with my predictions? My best guess for Q2 back in July was that the company would come in with revenues around $1.35 billion, a net loss of $14 million, and earnings per share at negative 3 cents. The total revenue actual was $13.97, so I was off by 40 million or so, very close. The net loss was 4.7 million, still a negative, a little bit better than I was expecting. And the adjusted net loss was 5 cents negative versus my expectation of 3 cents negative. What does this tell us? It tells us that my model is working fairly accurately, and it is best to have reasonable expectations, not only best case scenario expectations when you're trying to predict AMC's earnings. Year over year, almost every metric on here is an improvement compared to Q2 last year, but remember Q1 and Q2 of 2024 were affected by the actors and writers strike. So as long as you don't have a strike in place, I think a normal person would expect that we would handsomely beat results from a year ago. So the company is focusing on that year over year improvement. That is not so impressive to me, considering the strike a year ago. I want to see good results. These results are good. They're not quite good enough to get the company both net income positive and free cash flow positive, but there's a lot to be said about being adjusted EBITDA positive and free cash flow positive. So all in all, a balanced quarter, not quite where we want it to be yet. And, hopefully things get better into Q4 and 2026. These quarterly results provided me some great new data points to update and refine my model based on the latest data. And that's what we're going to talk about next. If you remember back to the July video, I gave you guys kind of a low market share, medium market share, and high market share outcome for AMC, saying that depending on what the market share came in at and the food and beverage, that would define AMC's Q2, but that I was sticking with the low estimate for my July prediction, and we came in very close to that. I used a 28% percentage of the domestic box office for that estimate, and the actual came in at 28.53%. The difference being this 40 million on revenue and the 10 million on my estimate versus actual net loss. and the difference in the net loss per share. The first thing that I do to double check my model and make whatever changes and refinements I need to make is I will update my estimate versus the actual and see how close the model would have been if we came in exactly correct on the market share. And then I would have had only a miss on total revenue of $21 million, and we would have been off by 3 pennies, 5 pennies actually, on the earnings per share. The model still would have predicted a positive result for AMC, even with that market share. So the next step I take is, why didn't they meet the model expectations? Why was there a loss with this market share? And we're going to talk about 2 or 3 of those buckets just so we kind of understand how the company missed, why it was a negative result in Q2. Looking at the model to see what is different between the actuals versus what my model would have predicted in this scenario. One thing that jumps out is that the food and beverage percentage of admissions revenue I had conservatively at 63%. It came in at 65.5%. That is awesome. And it also kind of lines up with a similar box office back in Q3 2024, where it was 2.6 billion in domestic box office, and we had 65.9% food and beverage percentage of admissions revenue. That is a data point that I will carry forward. Next time we expect box office to be a little bit higher, maybe I'll bump this up from 63 to 65%. The next thing that I notice is that the food and beverage cost came in a little bit higher than I would have normally expected. It came in at 19.24% of the food and beverage revenue, about half a point higher than I would have normally expected. Probably some inflationary issues going on there, slightly higher cost on food and bev. Rent was slightly higher than I had forecast by about $8 million, so I will need to update that for future quarters. The other bucket here was a little more expensive, and depreciation was a little bit higher than I had anticipated. So the net result is we came in at $45 million higher than my model had predicted on operating costs and expenses. Corporate borrowings, the interest expense stayed steady at $109.6 million. I do expect it to go up in Q3. I know they paid off a little bit of debt, but interest rates did go up, and my calculations tell me that there will be a slight increase in the corporate borrowings in Q3. And so stay tuned for that. We'll see if that expectation is correct. That is my expectation, and that is what I will be modeling for Q3, a slight increase in the corporate borrowings. And the other really interesting thing here is this line item, non-cash NCM exhibitor services agreement. It's been very steady around $9 million. There was a $10 million increase in this bucket item. Even though it is non-cash, it did impact the net result for the quarter, and that jumped to $18.6 million. I could not find any firm management notes explaining why that jumped up. I'm going to take note of it for this quarter and see if that is something that we should expect in future quarters, and I won't know that until we get the next quarter results. Is it going to be 9 million next quarter or 19 million? I can't tell you, but I'll probably model the worst case scenario and then cross my fingers that maybe this was some one-time thing. I don't think it's a one-time thing, but you never know. We'll know on the next data point, Q3. All right, so what do I do with all of this data? What have I been doing all morning? I have been looking at where the model was incorrect and what data I can use from the Q2 results to make the model more accurate. And there were some variable cost calculators that I was able to update. And just to look back at what I had predicted, negative 14 million came in at negative 4.7 based on 28% versus 28.53% up here on admissions percentage of domestic box office. Let's change this to match again. 28.53. You can see that the model would have been off by about $21 million on net profit and 5 pennies on the net loss versus net profit. What changes can I make using the data? I went in and made some changes to this line item, which is a variable cost calculator that I created for operating expense. And when I plug in the updated formula, let's see how much more accurate the model becomes. I'm going to paste in the new formula with more granular calculator. And we come now to only a $10 million, $11 million difference in net profit loss, and only 2 pennies off on the net loss per share. Much more accurate than the model was last quarter. It's never going to be perfect, guys, but I strive to get the most accurate calculation possible using reasonable expectations for box office and market share. A lot of questions this morning coming into me about what is going to happen with interest expense going forward. As I said a few minutes earlier, yes, I do expect it to go slightly up. Yes, I realize some debt was paid off, but the rates did go up if you read the documents. In a previous video back in the beginning of July, I shared with you guys, I believe, why the interest rates are going up. If you don't understand that, go read the debt documents from July 2025. Based on what I'm seeing, I expect the interest expense to go up next quarter, Q4, but you know, that might be affected by one-timers related to the July debt restructuring. So we will see. We will see over the next few quarters what the debt service costs this company. And people want to know, when can we expect the debt cost to go down? The company's got several things they need to focus on to restructure the debt. And just to recap, I want to see on an annual basis a positive net income, positive EBITDA, positive free cash flow, and the company needs to improve its debt to EBITDA ratio. The company currently has a junk rating, credit rating from Moody's and S&P. And the idea is, if all of those things that I just listed, the positive net income, positive EBITDA, positive free cash flow, improved market perception about what box office is going to do, and improved debt to EBITDA ratio, if all of those things can happen over the next year or two, then I think it is likely or reasonable to presume that Moody's and S&P could upgrade AMC on their credit rating. I'm not saying they're going to make it investment grade, but even going from a C level to a B level could enable AMC in the next year or two to restructure the debt again for a lower interest rate, shaving 1% to 3% off of the interest rate, saving them millions of dollars of interest expense per quarter. A lot of things need to happen for that improvement to happen. And I think that you should be listening very closely to management in today's call and in future calls to see if they continue to say that improving the balance sheet is a top priority. Because if it is, they are looking at how to improve the debt to EBITDA ratio. There's 2 ways to do that: improve EBITDA or decrease debt. And if you're pulling the lever of decreased debt, to me, that means there is still potential out there in the future of some debt for equity swaps. A necessary evil, dilution to decrease the debt and improve that debt to equity ratio to get to that point in the future where you can get a credit rating upgrade and refinance the debt for a lower rate. This has got to be an important thing that management is thinking about, and I'm going to be listening to what they say about their priorities. And if they say that their priorities are continue to fix the balance sheet, that is how I'm going to view it. Some of y'all might not like that. That is my opinion. I think that if they say that improving the balance sheet is a priority, it would be reasonable to assume that there is more dilution coming in the future because management needs to fix that debt to EBITDA ratio. As we wrap up this video, and we're getting very close to market close, the stock is still trading at $3, still up about 2.5%. I hope to see you guys on the live stream after the market closes to hear the management call. I will be there. I hope to see you there. If you have any questions or comments about today's video, please feel free to drop them down below. I love to hear from you guys. Thank you for watching all the way through, and I will see you on the next video.